And we put the spotlight on Indian markets after consolidating for much of 2025 and underperforming global markets. Analysts and brokerages are now turning upbeat on Indian equities. Here's a report that decodes the risks and opportunities.
Indian equities ended the week on a mixed note as the Nifty 50 briefly touched record levels before retreating amid rising global volatility. The index slipped on the last trading session of the week. That was mostly due to weakness in major overseas markets, particularly the sharp correction in US tech stocks. Despite the pullback, Indian benchmarks remain near all-time highs. Foreign portfolio investors have added over $1.3 billion since October, encouraged by improving earnings expectations, easing consumption taxes, and progress in India-US trade negotiations. Analysts also note that the breakout from recent ranges keeps the trend constructive, though near-term swings may persist as markets digest global rate uncertainties and sector-specific pressures. The week also saw a flurry of 2026 forecasts from global brokerages. HSBC expects Indian equities to deliver around 10% annual returns and has placed its 2026 Sensex target at 94,000, citing healthier valuations and a revival in earnings. Morgan Stanley sees a broader market reset ahead, projecting 95,000 on a base case and 107,000 in a bull scenario, banking on falling rates, improving credit trends, and strong domestic demand. Goldman Sachs turned overweight again, with a 2026 Nifty target of 29,000, signaling confidence that India's earnings downgrade cycle has bottomed out. On the other hand, UBS remains cautious and underweight, arguing that valuations still look stretched relative to fundamentals, despite macro tailwinds. Franklin Templeton expects modest earnings growth in FY26, but a sharper improvement in FY27, especially for financials. While most brokerages remain bullish on India, the risk due to global trade disruptions and geopolitical tensions persist. Bureau Report, WION. World is one.
And for more on this, to discuss more, we're now being joined by Mr. Ajay Bagga. He is a market expert. He's joining us from Mumbai. Thank you so much for joining us on the broadcast. Now, Indian markets are close to record highs now. Do you see the benchmarks and the broader markets rising significantly from these levels?
Yeah, definitely. If you look at the last 14 months, India last made this all-time high in September 2024. So it's taken 14 months for us to come back to similar levels. We have not stayed above it still. That should happen in the next couple of weeks, hopefully. But from here on, what history has shown with such underperformance, normally the next 12 months, the market performance is quite strong. So we expect the Indian markets to go up in the coming months.
And if that does happen, what kind of impact will that have on the US-India trade talks on the broader markets?
Yeah, we are expecting some kind of relief to India on the tariff front. One, Russian oil is no longer being bought by most Indian oil refiner companies. So we are expecting that 25% punitive tariffs from the US to be reduced. There is a lot of street chatter about an impending US-India trade deal. The India tariff should come down to about 15%. So that is the expectation. That will have a very positive impact on market sentiment, and it could boost Indian equities.
Retail investor participation has usually increased when Indian markets race to record highs. Do you see this trend continuing this time as well?
Yeah, definitely. In fact, even when the markets have underperformed over the last 14 months, we have seen retail money coming in very strongly. So we expect that to continue to increase. The good news is out of the household allocations, only about 6% of financial assets are still invested in equities. So there is a huge runway of increasing this allocation going ahead. So we expect the retail participation to continue to grow from here, and it will become the dominant driver of Indian equities in the years to come.
All right. Of course, we'll be looking forward to that. Thank you so much for joining us on the broadcast and giving us a snapshot from that.